Investing is the sexy part of this 5-part series. And I say that because we all like to invest. We like to put something somewhere and let it grow and make money and see our hard work compound. But there's a lot more to investing than most of you understand. And a lot of you have attempted to invest, maybe even on your own, and had really bad luck, or you had no direction. And so in this video, we want to walk through what is investing, how to invest, and how to get you on a better path going forward so that you can actually use your money, your investment money, to grow wealth and get to the position down the road that you want to be and that you need to be. So let's quickly touch on the basics of investing. Now, if you already know this, that's great. It's good to learn a bit more. And for a lot of you watching this video, you really don't know what investing is other than, you take money, you put it in a stock and hopefully it goes up. But the reality is when it comes to investing, there's a lot of options. And this kind of goes into avenues. Avenue one is types of investments: stocks, bonds, mutual funds, seg funds, ETFs. There's different types of investments that you can get into, and I'll dive into those in a second. The other avenue of investing is what type of account. Do you use a non-registered TFSA, an RRSP, an RESP, defined contribution plan? There's a lot of different options, that avenue as well. So let's hit avenue one first, types of investment. So there's stocks. A lot of you understand stocks. What is a stock? When you buy a stock, you're investing in a company. So if you buy Apple stock, you are a part owner, a very small fractional owner of Apple. You are a part owner of Apple. So that's great. So if Apple then goes up in value and the stock price thus goes up in value, you're going to make money. If it goes down, you are going to lose money. So that's essentially a stock. Again, we're more of a financial planning channel here. There's a lot of videos on YouTube on investing on stocks. So if you want to learn what is a stock or just Investopedia, you'll learn a lot more. Now bonds is more of a debt instrument. It's a bit safer. It can still lose money, don't get me wrong, but you're buying into the debt. So let's say, if we talk about a government bond, let's say the province of Ontario needs to build a new bridge and they need to raise money to do that. They might issue a bond. Now they might issue that bond, let's just say at 5%. So if you buy units or shares of that bond, what you're doing is you're investing money. They're using that money to build the bridge. And let's say it's a 5-year bond at 5%. They're going to pay you 5% of whatever you invested on an annual basis. And at the end of the 5 years, they're going to give you your money back. So if you put $100 in, they're going to give you $5 every single year for those 5 years. At the end of 5 years, you get your $100 back. Now, there's different investment grades to bonds, and I won't dive into all that because that's, multiple videos going forward. But again, educate yourself around bonds. What is a bond? How does it work? Is it the right fit for you? And how to go about buying them. Next, I'd talk about mutual funds and ETFs. Now, what mutual funds and ETFs are is they're a basket of stocks and potentially bonds, or maybe just bonds. Now, you can buy mutual funds or ETFs through your discount brokerage, through your investment advisor, different ways to buy it. Now, I'll say this, mutual funds are typically a lot higher priced than an ETF because a mutual fund will have attached to it fees to pay, the bigger company like a Fidelity or McKinsey or something like that that's creating those, and they're paying portfolio managers to pick stocks to fit into those mutual funds. As well, you're typically paying an advisory fee. So your financial advisor is also collecting a fee, a commission on that to sell you that. So typically your mutual fund is going to cost a little bit higher than an ETF. Now, an ETF primarily will track an index. What is an index? It's a stock. So let's say the Canadian stock market is an index. So if you're someone that says, you know what, Adam, I want to invest only in the Canadian stock market. I just want to buy the whole stock market. So if the market as a whole goes up 1%, I also go up 1%. You could buy a Canadian stock market index fund, and there's a few of them out there. So there's an index fund for a lot of different things. If you only wanted the Canadian banks, you could do that. If you only wanted, oil and gas, you could do that. So it'll break it down into sectors and regions. There's a lot of different options out there. So again, do your research. A lot of you are just jumping into things that your neighbor tells you about. So when you look at the basics of investing, you really need to educate yourself. You shouldn't be investing in a stock if you don't know what a stock is. You shouldn't be investing in a mutual fund if you don't know what the mutual fund is and what you're paying for it. That's another big factor of this, right? So understand what you own and what you're paying. Now, obviously within kind of the stocks and the bonds and mutual funds and ETFs and the types of investment, there's obviously a different level of risk. And so this comes back to what is your level of risk? How much risk can you take? And a lot of risk assessments, which I'm not a big fan of, but if you're starting to invest, it's good to go through it and kind of test yourself or work with your financial advisor and go through that test. And a lot of those questions will be, if your account goes from $1,000 down to $700, how much fear and how much anxiety does that bring to you? And so it'll have these different levels, and you'll figure out like, maybe I'm a bit more conservative than I thought. I should probably take it easy, have someone else manage this, and be conservative within the investment scope. Maybe you're more aggressive. So it's a good way to kind of figure out and self-assess how much risk you're willing to take internally. So after you're done watching this video, I encourage you to go out there and search for more videos around what is a stock, what is a bond, what is a mutual fund. Educate yourself on these types of products. Now, when it comes to types of accounts, TFSA, RSP, there's a lot of videos on there. Our main channel actually has a lot of videos on TFSA, RSP, how to use them, how to build them up. But in general terms, you want to look at your income tax threshold. So what is your marginal tax rate? Which means that on the next dollar that you make, how much tax are you paying? And for most provinces and territories, it's around $50,000 to $55,000. There's a bit of a bump. And so our general rule would be, if you make above that threshold, look to invest in an RSP to get that tax break. If you're under that threshold, look to utilize a TFSA, because you're not getting enough tax break to put money in an RSP. Start utilizing the TFSA. When you put money into an RRSP, you're going to get a tax break. So let's say you make $60,000 a year, you put $5,000 into the RSP, then you're going to be taxed at a $55,000 level. So at $5,000 that you put into the RSP, CRA will not tax you on that amount, only on $55,000. So it's a way to kind of put money aside, not pay tax on it. It'll grow tax deferred, meaning that $5,000, as it's invested and grows and grows and grows, you don't pay tax on it until down the road in retirement, where you pull it out. And the idea is, in retirement down the road, you'll be in a lower tax bracket than you are currently and will pay less tax on that money in the future. Now again, if you're under that kind of $55,000 threshold of income, then you want to utilize the TFSA. Now the benefit with the TFSA is it will grow tax-free. So that, say you put $5,000 in there and it grows and grows and grows, you don't pay tax as it grows ongoing, and when you pull it out, either at retirement or before, it's fully tax-free. So one gives you a tax benefit now, one kind of gives you a tax benefit more ongoing. So they work kind of a yin and yang, hand in hand, but it's important that if you are a higher income earner, it's likely worth it to start utilizing that RSP, save that taxes. You could take your tax refund, invest it into the TFSA, and start compounding your money a little bit better. The next part is to make sure you have an investment plan, and this ties into types of accounts. Like if you're saving for retirement, then an RSP or TFSA is great. If you're saving for a kid's education plan, you don't want to be saving in an RRSP because that's not used for education. You want to save in an RESP, Registered Education Savings Plan. If you're saving for a down payment for a house, make sure you understand the rules of the home buyer's plan. What's available to you. Again, lots of videos out there. We have some on our main channel around the home buyer plan or the first home savings account, which we have a video on this channel about. So learn what these kind of savings tools are, but have an investment plan. Every single dollar that you invest needs to be allocated in the right direction. And we had a client not too long ago that came to us and they said, Adam, we're ready to buy a home, and here's kind of our situation. And they had been piling money away into the RSP because they were high income earners, but they hadn't saved anywhere else. And so yes, we could pull out a bit for the home buyer plan, but they were kind of limited and they couldn't use a lot of their savings for the down payment that they thought they could use because they were ill-informed earlier on in their life. And they had just piled way too much into the RSP based on what they needed the money for. It's great. They have a great retirement plan set up at an early age, but they couldn't get enough of that money out for the down payment for the home. So it actually crippled them in what they could buy a little bit. So just be aware of that. Understand why you're saving money, where you're saving it to, and what the end goal is. Again, retirement, typically more TFSA and RRSP. If it's shorter term, look to a TFSA. If If you can use a home buyer plan, know your limits and utilize that within an RSP or the first home savings account. If you're saving for a shorter term need, something like that, a TFSA or even a non-reg, like a high interest savings account can be good. Alternatively, on RESP, if you have kids, utilize that RESP. We have video series on our main channel around RESP, so check that out. But the government gives you 20% for free. So if you're saving, if you want to help your kids, if you have kids and you want to help them with post-secondary education, the RESP will give you 20% grant, essentially a 20% rate of return right off the bat. The third part of this is choosing the right investment. So you have an investment plan, you kind of have an understanding of what investments are, you have a plan, and now you actually need to go out and choose the right investments. And again, I'm not licensed to tell you what to buy, but I can say this: do your homework, and if you don't feel confident in this, then lean into either an advisor or a platform like a Wealthsimple or Questrade, where they build portfolios for you. So Wealthsimple has kind of a managed portfolio option, and this might be a good solution for you. Again, everyone's going to be different. Every single one of you that are watching this video will have a different approach to investments. So I could have, a 2-day long video and I still wouldn't hit all of you on what the best approach is. Everyone's going to be different. So figure out what's best for you. It might be, Adam, I'm just looking to save money and do as best I can. But, investing scares me and I don't want to do that. Well, then you need to find someone or a firm like Wealthsimple or Questrade or some of these robo kind of advisors that create, managed portfolios with ETFs. So Wealthsimple, for instance, will take 7 to 9 typically ETFs and bundle them together and kind of sell it as a package. So conservative pool or a balanced pool or a growth pool, that kind of stuff. And it's managed by professionals in the background at Wealthsimple. So again, you can do your research on these pools. Maybe that's the right fit for you. Maybe you want to talk to someone at the bank or your local investment firm and have them build out a plan for you. Everyone's different. But again, understand what's best for you and then also what you're investing in and what the costs are. Again, more bodies you get involved, typically the more it's going to cost you, which might be worth it for you, it might not be. But understand. Now the fourth part, and this is by far the most important, is to make sure you review and analyze your investment portfolio. Too many of you are either, never watching it. It's something you maybe look at once a year. And then there's the other side of the coin, which is you're looking at it every day. And I don't want you on either side of the bookcase. I want you in the middle. I want you to be checking your investments. I would say once a month is a good thing to start with. So if you're doing your own investments, it's a little bit different. You're gonna have to watch it a bit more often. Again, make sure if you're managing your own money to understand how this all works. There's a lot more to it than what you think. And I always say, it's easy to buy an investment, it's hard to sell an investment. So understand that, like what's the selling point? That's the hardest part about money management. So if you're someone that, is having someone manage it, or you're doing like a Wealthsimple or Questrade automatic type thing, jump in there once a month, understand what it's doing, but understand the long-term goal of it. Too many of you, and especially watching this video, if you're younger and you're kind of new to investing, you're gonna, invest in, investment A, whatever it is, a stock or bond, mutual fund, doesn't matter what it is, but investment A. And investment A, after 1 month it goes down and maybe that's not gonna work. And then you sell it and you buy investment B. And it kind of goes up a bit, I'm doing good, and then it drops, and you sell it. And you're kind of in and out and in and out and in and out. And that's a terrible plan to have. Now again, you need to review and watch your investments and make sure they're doing well. I mean, if they're not doing what they're supposed to do, and maybe things have changed on the investment landscape, maybe you do need to change that investment. But a lot of you are just getting in and out, in and out, in and out. And you probably know people, you talk to people and say, you should have bought Apple in late 2008. And sure, we all should have bought Apple shares in late 2008. Or maybe it was Tesla in 2019. And there's always going to be points it's like, I should have just bought that. I would have been a millionaire by now. I missed the boat. And then we try to basically do that. We try to hit home run after home run. And so my encouragement to you is, again, understand what the investments are. Understand kind of the plan. Have a proper plan in place. Then you want to make sure you choose the right investments and then review them. And don't go swinging for the fences. Have a clear strategic plan that will move you in the right direction, but it's not going to go from 0 to 100 or from where you are back down to 0. So understand what the goal of the investments are. And I see it again and again and again where people come to us and they say, Adam, I have $3 million and it's because I bought, Tesla in 2018 and it's gone up and I've made all my money there and I can retire early. I see that once in a while. But you know what I see more? I see the other side. We took 100 grand, 500 grand, we put it in a stock that my neighbor, my coworker, someone told me about that was going to be the next Apple, and it's worth zero. And we're basically, in our 40s and our 50s, later in life, not a lot of time to save, and we're starting again. And so I don't want that to happen to you. So create a clear plan, understand your investments, and make sure you follow and review that investment on an ongoing basis.